Today is Monday, June 16th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Mark Bowman, ADMIS Senior Market Research Analyst, and JP Steiner, ADMIS Associate Economist. Starting with the grain markets this morning, Mark, at what price level would you expect the recent surge in soybean oil to stall out?
Well, we have expanded limits today, so spot futures can trade as high as just over 55 cents. So far, prices have stalled. 54.80 was the high before pulling back here a little bit. And that's the highest level now since October of 23. Friday's announced RVOs effectively at 5.6 billion gallons for 2026 was well above market expectations and continues to fuel this price surge. Combined renewable diesel and biodiesel production peaked last summer at about 460 million gallons a month. So you annualize that, it comes into about 5.5 billion, just below this mandated level. So I'd expect production to gradually pick up to last summer's record highs by late this year. The USDA, they're already forecasting a record crush for the 25-26 marketing year at 2.49 billion bushels. With Friday's announcement, I think you could probably tack on 30 to 50 million bushels to this forecast. The market's already responded with new crop crush margins. They've surged here almost out to $2 a bushel here on the new crop contracts just over the last couple of days. That's well above the old crop, which recently bottomed out at about $1.20. Bean oil as a percentage of product value, that's approaching 48%. The all-time high there is just over 50%. So to me, I think the market's already done a good job of discounting the Trump administration support for U.S.-based green energy for soybean oil prices to rally up to the 58 to 60 cent level. I think you're going to need just much more of a threatening weather forecast, which really not seeing that at all right now. With the expectation for higher crush only increases the amount of domestic soybean meal. Prices there selling off to new contract lows, which is also weighing on corn prices as well as more competition there in feed rations.
And Mark, you mentioned weather. Can you give us a quick weather update and how this may impact the agricultural markets?
Yeah, weather right now is clearly a bearish feature. We've got some pretty heavy rains across some areas of the southeast plains and southern Midwest. That's worked to slow the winter wheat harvest. However, by and large, much of the nation's midsection is in good shape. Only 18% of the corn acres in the U.S. right now are in some form of drought. That's down from its peak last fall at 81%, and only 13% of the U.S. bean acres are in some form of drought. And looking forward over the next week to 10 days, it just looks like remain in that favorable weather pattern with a good mix of warmth and sunshine and some rains. Right now, no strong indications of a blocking high pressure ridge forming over the nation's midsection, bringing an extended period of heat and dryness. So I think this will work to limit the upside potential, while for corn right now, I think has got a good possibility of challenging this $4 level unless this weather forecast changes rather soon.
Thank you. JP, we have a Federal Reserve meeting this week. What can we expect?
So the Fed is widely anticipated to hold rates steady at its meeting this week as it continues its wait-and-see approach to monetary policy while they manage their delicate balancing act, navigating its way through tariff headlines and economic data, weighing inflationary risks against signs of an economic slowdown, as all the data is backward-looking, making the Fed putting the Fed in a little bit of a difficult situation. But at its recent meeting, the bank held rates steady, reiterating its wait-and-see approach, while also highlighting the downside risk to the economy, which could negatively impact employment and inflation. But what many are actually eagerly awaiting at this meeting will be the Fed's updated summary of economic projections, something that they do every other meeting and could potentially signal if 2 rate cuts are still to be expected from the Fed this year. The projections will also include its coveted dot plot, which is a quarterly publication and shows the Fed's official prediction about the direction of the federal funds rate. The last dot plot, released in March, revealed that Fed officials expected 2 rate cuts this year, as some are already factoring in the uncertainties of President Trump's economic policies into their projections. But many expect the Fed to stick to this guidance, seeing no changes, reinforcing expectations of 2 rate cuts this year, with many expecting the first rate cut to come at the September meeting. So all in all, really no surprises expected at this meeting. However, eyes will be focused on its summary of economic projections.
And JP, looking at the gold market, what factors do you think will drive gold prices this week?
Yeah, so obviously, there's many headlines and events happening right now and later this week that have a strong potential to impact gold prices. First, the continued tensions and conflict in the Middle East will drive safe haven demand, as fears that the conflict could spill over to neighboring countries and bring in other regional players worries investors. However, a report from the Wall Street Journal this morning indicated that Tehran has reached out through several channels to Israel and other Middle East players, saying it was willing to head to the negotiating table as long as the U.S. does not get involved in Israel's attacks. However, only time will tell as to the conflict. Any continued escalation in fighting will bring heightened safe haven demand and support for gold prices, while any de-escalation in the conflict will drive demand away from the yellow metal. Like I mentioned before, several central banks across the globe are set to meet this week alongside the Fed, notably including the Bank of Japan and the Bank of England. Commentary from these banks and from any officials following the meetings will be key in determining future monetary policy direction from those banks. Gold benefits in a lower interest rate environment, so any signals on a future of lower rates would be supportive of gold. However, commentary regarding current economic conditions in these regions will also be closely watched, as uncertainties surrounding the impact of tariffs remain not only on the U.S. economy, but more importantly on foreign economies as well. At-large trade uncertainty has been a big catalyst in elevating gold prices over the last couple months, and any echoing on continued uncertainty would be supportive of gold as well. Now, we also see inflation readings, CPI inflation readings to be specific, from the UK and EU as well. So investors will be watching bank headlines and inflation readings, as well as keeping their eye on the news for any developments in the Middle East.
Thanks, JP. Mark, Bowman, looking at today's Unica report, what does it tell us about the sugar market?
So the Unica report to show Brazil Center-South cane crush for the second half of May was up 5.5% from the same period last year, which was more than expectations, calling for an increase of 1.2%. Likewise, sugar production was up 8.9% versus expectations for up 4.7%. The crush was a bit larger than last year, but the sugar share of crushing was also up, coming in at 52% versus 48% last year. So more of the cane going to sugar production as opposed to ethanol. Now, cumulative production is still behind a year ago, but we've been narrowing the gap. Now we're about 12% behind last year versus 23% being 23% behind in mid-May and 39% at the end of April. The wet conditions in late April that slowed the harvest and crushing vanished and or more or less dissipated, and we've had drier conditions in May that has allowed the pace to pick up. Now, the question is, what does this say about Brazil's production this year? There had been concerns that the drought last year may have hurt production prospects for this year, but they seem to be dissipating as we recover our production. Also, as of mid-May, forecasts were calling for production to be 4 to 5% ahead of last year. Now, we've had some pressure already, though. We got good monsoon seasons in India and Thailand. It's expected to boost production from this year. But this morning, after the report came out, the market did reverse higher after falling to its lowest level since March 23rd. So a bullish reaction to a A bearish report could be bullish. The market is oversold as it is. We're kind of overdone on the monsoon theme. Open interest has been increasing on the decline, though, indicating that sellers, up till now at least, have had the momentum.
And Mark, lastly, what was the USDA's assessment of the U.S. cotton situation in last week's supply-demand report?
Okay, so they lowered production for 25-26 for the U.S. to 14 million bales, down from 14.5 million in May. This is because they lowered harvested area to 8.19 million from 8.37 million, and they dropped yield to 820 pounds per acre from 832. And this was due to the heavy rains, very wet conditions in the Delta this spring that have delayed plantings and now starting to put the crop into doubt. Ending stocks now 4.3 million bales versus 5.7 million in May, and this tightens the situation somewhat. We have now stocks to usage ratio at 30.8%. This is now down from last year's 33.3% and down from 36.6% in May. So we've gone from expecting more supply from last year to less supply. However, this is still above a long-term average, 5-year average of 27%. So it just shows a tightening from last year, but not a critically tight supply. The prices based on regression analysis, prices now right where they would expect to be as on the close on Thursday, the day of the report, when you look at the last 20 years of comparing the closes on the day of the June report to the supply-demand situation. There's still a great deal of uncertainty over export prospects, with China having been one of our biggest buyers in the past, though they've not been the last couple of years. And we may need to count and not be able to count on them for much business in the future. So we better hope that Vietnam and Pakistan remain interested. And there's still no improvement in the Delta in sight for at least the next 10 days. They got more rain coming, not chance of a dry out. So the market may need to feel the need to build a somewhat better weather premium. But overall conditions, okay. Texas looking decent. Then not much drought. They could use some rain through the season, but they've drying out this past week may have helped them advance the plantings more.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.